Good afternoon, everyone, and welcome to today's Payments Association webinar, Innovation versus Risk, Closing the Trust Gap in Instant Payments. My name is Berenice Lamblin, and I am part of the production team at the Payments Association. Before we get started, I'd like to go over a few things. So you can submit questions to today's speakers by typing your questions into the Q&A tab of the control panel. You can send in your questions at any time, and the panel will address them during the Q&A session at the end. You can ask questions anonymously if you do not want to share your name, and we'll be moderating them as they come through. This webinar will be recorded, and we'll send a link around to watch on demand afterwards. Finally, if you have any technical issues, feel free to send a message through the chat box to Aisha Waris from the Payments Association. I would now like to introduce Vicky Magnisali, who is a payments and regulatory expert with years of experience in the field. Vicky will lead today's panel. Hope you enjoy. Over to you, Vicky.
Thank you, Bernice. Hi, everyone. In today's webinars, we would like to explore how instant payments are transforming the way the money moves, but speed fundamentally also changes the risk equation. So as a payment innovation accelerates, at the same time, fraud also accelerates. And technologies, firms are trying to rely more on technology and AI to tackle these types and different types of fraud. But what we're going to discuss is this enough? And is there a trust gap between the consumer, for the consumer and the payment and the instant payments? Regulators are also responding, and we have seen recent regulation in the UK coming and also in Europe addressing those types of fraud. And we're going to discuss this with our experts, but we're also going to touch on items from the compliance point of view, and is the compliance reacting to the regulation? Should they be more involved within the payments organization and with central banks as well? But also we're going to talk about from the consumer's point of view and from the victim's point of view. We are joined here by experts from banking and fraud experts as well. And I would like themselves to introduce themselves because they're definitely better talking about themselves than I am. So I would like to start with Alison. Welcome, Alison, if you can quickly introduce yourself.
Thanks, Vicky. Hi, everyone. My name's Alison Copra, and I'm a director in the financial crime team here at Grant Thornton. We help clients from FS and beyond navigate financial crime, risk and compliance challenges across AML, sanctions, fraud, anti-bribery, or the usual suspects. My experience is primarily in the banking and payment sectors and ranges from things like Section 166 skilled person reviews, fraud framework assessments, and AML and fraud remediation and transformation projects. Thanks.
Thank you, Alison. Moving on to Anna.
Hi, everyone. My name is Anna, and I come from Nordea. We are one of the largest banks in the Nordics, and my responsibility is to look after the user experience in our digital channels, and specifically related to payment origination and account origination. I'm based in Copenhagen, and I have been in the banking for the past 10 years, and actually I think also around 7 years, specifically in payments, working with multiple payment types, domestic, cross-border, open banking. Happy to join here.
Thank you, Anna. Dal, would you like to go next, please?
Hi, everybody. I'm Dal Sahota, and I'm the director of our Trusted Payment Solutions here at London Stock Exchange Group within the Risk Intelligence Division. Within that division, we're on a mission to eradicate financial crime, encompassing fraud as well. So in my capacity as director for our Trusted Payment Solution, I focus on the product strategy, bringing products to life and to market to aid in fraud prevention across the globe. Back to you, Vicky.
Thank you, Dal. And Daniel, over to you. I don't know if Daniel can hear us. Anyway, we might have to come back for that for Daniel. Okay. So let's start the conversation. I would like to start the conversation what is currently in place in terms of regulation. And I think, Anna, I will come over to you because you are more into the payment side of things. And do you feel that the current regulation is keeping at pace with the risk emerging, with the fraud risks emerging? And have you seen a change in the consumer's behavior since the confirmation and verification of pay has been introduced?
Yeah, so we have implemented the instant payment regulation in October, and I think this is, of course, a great value proposition, right? And it's on par because the instant payments are becoming a norm, so this is very much needed. And we have implemented also verification of payee. And I think it's a good mechanism for additional fraud prevention, because also we can't escape from having the fraud monitoring, so that has to be still there. So both on the normal payments, on the instant payments. And with verification of payee, I think the key here is also about the user experience. So how do you convey to the customers the change, that this is to their benefit? So that was one of the things we needed to solve. So this is helping the customer and not making the flow more difficult, and that you are still actually able to make a payment despite the result. So I think for us, it was good. But of course, like the first time you launch, you maybe see some feedback, and then the key, of course, to react on the customer feedback as soon as possible. So that was the key for us. Mm-hmm.
Thank you. And Alison, from the fraud point of view, do you think that such a regulation is addressing a lot of the big fraud concerns at the moment?
I think confirmation of payee in the UK and verification of payee in Europe, it certainly does have a tangible impact when you look at, you can see in the fraud statistics and data when there was the first rollout of confirmation of payee in the UK and then the expanded rollout. You can see the impact that it had initially. That said, it's not foolproof. It's one aspect. It certainly helps, but as with everything fraud related, fraudsters are constantly evolving to try and get around and circumvent the additional controls and protections that are put in place. I think there's some basic fraud typologies that immediately it kind of helps if you're making a payment for something on Marketplace, or you think you're paying an invoice. If it comes back when you enter the payment so that those don't match, it does give consumers cause to pause and then go and check those instructions. But it's not foolproof, and fraudsters are evolving ways of building those into scams, for example, to get around those. But every protection, there's no magic bullet, and I think it's a case of layering protections and trying to build protections through multiple controls in place.
Thank you. And Dal, from your point of view on the fraud side, Alison mentioned that obviously the confirmation of pay and verification of pay gives that small pause to the consumer to check the account details. And maybe that is because a lot of the fraudsters are using urgency to make you do the payment instantly. And you do pause for a second there to check the name of the beneficiary. And do you feel that this is adequate, or is there more that needs to be done for the consumer to further trust faster instant payments?
Yeah, I think if we're reflective of point in time, so if you recall years ago when there wasn't an ability to confirm who you pay before you pay, we lived in a world of trust is based on what we knew at that point in time, everything around that payment instruction, when that invoice came, where that request went, it was based on that level of trust. Clearly, there's been a lot of movement to create preventative measures, as Anna and Alison mentioned, and they're more combative in nature. So we now live in a world where we know, certainly in the UK and Europe, you can verify who you paid before you pay, which is great progress at a regulatory level. And there's other schemes and other regulation coming to fruition in other parts of the world. So I think it's the right movement in the right direction from a preventative, combative measure. but it isn't a cure to Alison's choice of words. It's not bulletproof. And therefore, actually taking a layered effect approach will create more of a directional move to cure rather than just preventative measures. And I think from a cure point of view, we're far away from a cure, but we are seeing progressive movement in preventative measures. I think I'll come on to a little bit later around what I think it will take to create full level of cure, but there's certainly movement in the right direction.
Thank you. And Anna, you've mentioned that all the banks implemented mandatory SEPA instant payments from October when the regulation came in, and at the same time, a verification of pay was implemented. Do you see that there is a movement from SEPA classic credit transfers to instant payments now?
Yeah, we can see that the instant payments are adopted, so they are being used. But we can see, because we give customers actually choice at the moment to go with the instant or with the standard payment type. So actually both are used. But I think, we will see probably more and more. And I think here there are also more applications. So this account-to-account transfer instant, it can be used other places, not necessarily through the net bank and mobile bank, but it could be used also by other providers, for example, to reduce their costs. So there is multiple applications. So it will be used in general much more.
And do you think the big corporates, if the limits were removed, if the internal bank limits were removed for instant payments, for SEPA instant, do you think they will switch even their large payment to SEPA instant? Do they trust them enough, or they will prefer something slower?
Yeah, I think it's difficult for me to comment for the large corporates, but of course we can see for the segments that I'm responsible for, so for the small corporates and for the private segment, that limits is of course an additional control that can help the customers feel safe. So I think the banks, also traditional banks, positions themselves as safe by having these controls, and they are known to the customers. And therefore, also we can see that larger payments are done through us, where of course smaller payments are done through fintechs and mobile payment providers. So I think it is still attractive to do instant payments with the bank because it's perceived that there are extra measures of security and fraud prevention that we offer.
Okay, which I think brings me to my next subject, the traditional banks versus the fintechs and the neobanks, and their approach to regulation and also fraud. Do you think, Alison, that there is a different way that the traditional bank will approach fraud and regulatory compliance to a fintech or a neobank, that they would potentially be looking for something quick to market?
That's a good question. So I think that, when you're comparing banks and fintechs, you do have to remember the backdrop of the fact that they've often got very different resources available to them. Not to mention potentially very different risk appetites in terms of the fraud risk that they're willing to tolerate. That said, I think what we're seeing now in the UK is a beginning of a general levelling up. The FCA's bringing in the PSR within its remit. We've seen fraud being brought into things like the scope of Section 166 skilled person reviews, where previously didn't tend to be included in a standard scope. And more APP reimbursement has meant that there's increased regulatory scrutiny and increased data available to the regulator to really look at which firms, comparing them across the sector, who are outliers in terms of their fraud controls. Now, we're talking about instant payments here today, and the key thing that switching to instant payments and having, like we have in the UK, a large volume of faster payments every day, is that you need to move to more real-time fraud prevention and detection, and that often means an investment in technology. And that's where the difference in available resources can impact what firms between payments and fintechs versus the larger established players, what they have available to them. For example, larger firms with lots of resources have got money to invest in in-house AI capabilities that perhaps the emerging fintechs don't. But there are also cross-industry initiatives to try and make sure that solutions in terms of kind of data sharing pilots and things like that aren't excluding the smaller players in the market. We can't have the cost of entry for some of these to mean that there's a whole section of the market that's not being involved in them. That's probably quite a long answer to your question.
No. And I think probably Dal would have things to say about this, because this is what he's also working on, right, Dal?
Yeah, absolutely. And I think Alison just hit it on some of the depth of your answer. It correlates well with what we're seeing out in the market globally as well. So I would say the DNAs of fintechs and traditional banks are very, very different in nature. And I think what we're seeing in the marketplace is those that are leading by virtue of taking best in breed. So the best of what traditional banks bring in terms of fraud and AML risk posture and overall risk management posture versus the nimble nature and savviness of technology for a fintech. And those that are leading the space, they're able to combine the best of breeding strengths to address problems, seek opportunities, and ultimately build trust in their propositions and their joint propositions. So I think that's fundamentally, an area of shift that we're seeing, and where we're seeing a shift in terms of best in breed. In order to bring that trust to market, to consumer and businesses, the trust of banks has been there for many, many years. They've been the cornerstone of the financial ecosystem for hundreds of years. The privilege of working for one financial institution that have been around for 150 years. I think in terms of the fintech aspect and what open banking and PSD1 and PSD2 have done for the market, it's literally leveraged a number of opportunities for consumers and businesses to prosper. And when you combine the bench strength of both types of organization together, you can see both the opportunity and for the consumer and the business, but equally do it in a very controlled fashion, whether it's against AML regulations or, as we're seeing more incumbently now, around fraud prevention overall in the ecosystem.
Thank you both. Thank you. And if we put in the internal compliance departments now in, so the compliance departments, in my experience at least, they tend to be more reactive to the regulation. Do we think that because of the way things are moving, and sometimes regulation, as Alison mentioned, is not bulletproof really, or sometimes is not moving quickly enough, do we think that the compliance departments for the banks and the fintechs and the neobanks would have to play a bigger role in settling those rules of fraud prevention or controls before even the regulation come in the sense being more proactive than reactive? I don't know, Anna, if you would like to go first.
Yeah, sure. I think, that's a good question. And of course, it makes good sense to implement the controls ahead of different deadlines. And I think the role also of the compliance department, as I see it, is also to be a sparring partner, because it's often quite much needed from where I come from, user experience, to have a dialogue. How can we address these mandatory requirements and also to prioritize? Because we often see multiple regulations at the same time. Everything is important and mandatory, but from the user perspective, we need to know what to focus on first, what gives the biggest impact and protection. So therefore, compliance department is also an important element to convey what's the value of the regulation, because it's not just must have just because there is always a reason and value either to the customer, to the bank, or to the both. So I see this is the key role. And of course, if we can implement in advance, that's better. Then you can also test it and react on the customer feedback much earlier and make a better solution.
Okay, thank you. And I think that is my experience as well. And I think, Alison, you touched on the S166 review coming from the FCA or the PRA and basically addressing specifically fraud. If compliance had been potentially more proactive, maybe there wouldn't be such a need for those reviews. What do you think?
Yeah, certainly. I mean, there's a lot of factors that will go into thinking of the regulator as to what they put in the scopes or not. One thing that we have seen is where organizations have had a fairly reactive firefighting kind of approach to fraud risk management, waiting until they see a problem with their clients before kind of acting, particularly on things like in a B2B business model, for example. The increasingly data-driven approach of regulators means that's blind spot isn't able to kind of continue for at some point, particularly if the organization is growing, that can result in a blind spot where they just have some volumes and values of fraud going through them that will attract regulatory attention at some point. And at that point, you're then in a dialogue with the regulator trying to catch up and put in place the more proactive measures. Traditionally, I think firms, for a variety of reasons, tend to focus on getting their AML obligations, which are a clearer set in the UK, in the money laundering regs, a clearer set of clear steps and things that must be included. And that's often a focus for startups to make sure that they've got all the AML processes and controls covered, that sometimes fraud is a bit more reactive and on the back burner. And with fraud, how it is in the UK at the moment, the volumes and the comparable data that's being shared in APP fraud on a regular basis, then it's not going to be a blind spot for very long.
Thank you. And Dal, based on what Alison said, do you think then that the compliance department, they will need more than the traditional skills that people who usually part of those departments have? Because as Alison was saying, they're focusing more on AML controls, but potentially they have to be even proactive and implement before even the regulation obliges them to.
Yeah, it's a really great question, and I think one of the areas I think about in terms of the proactive nature is actually it's not just on one team, such as a compliance function. In order to combat fraud and really move to a cure, it's very much a team sport. So compliance departments, CEOs of a business, the regulators, companies like ourselves and Risk Intelligence, broadly, to get to a level of cure, it's got to be a team sport effort. So I would say all participants that are out there in the market geared towards preventing fraud, that's where we're going to really start to cure fraud. Just going back to your question, I think from a compliance point of view, I do see some of that sentiment coming out when I engage with market and compliance teams and C-suite executives across the globe. I think what's inherently come through is not necessarily just proactive, but doing a continued risk-based approach in assessing where the organization sits at an enterprise level when it comes to fraud. Similar to what has been in place in the market, very much keeping of the ecosystem that business is operating.
I think the thing with the compliance department is that sometimes they are pressed for time to do all those AML checks, and that's why they tend to be more reactive and keep all the controls up to date and everything. And maybe that's why I said maybe we need a new type of compliance department that it's looking at the market trend of fraud, for example, and what are we seeing versus reacting or trying to maintain the existing in the as is. But I would also like to look at it from the consumer's point of view, okay, from the user point of view. And Anna, you mentioned that potentially compliance and regulation, they would also have to look on how to safeguard the consumer, but at the same time, not make it a very difficult experience or a painful experience to make a payment. And also, would the consumer potentially prefer a slower payment method that would be more secure versus an instant money movement?
Yeah, I think instant payment is justified in many occasions. For example, if you want to have instant reply, so I transferred the money to my friend, to my family, did they get it? Or if, for example, if I do payment for a service or a product, so I need to also understand, has the money arrived so the service and product can be delivered? But then, of course, in the situations when customer or the user is not there when making a payment, for example, authorized to make direct debit or some withdrawals for the subscriptions. So here, of course, it doesn't need to be instant payment. So it could be a choice for the payment service provider how to do it. So it can be different situations, but also from user perspective, sometimes it can be good to give a choice. But on other hand, if there is no clear value why to choose maybe slower payment type, or if customer needs to understand what does it mean? Does it mean that my money arrives in 1 hour or tomorrow? Maybe it's too complicated, right? So it's then easier from customer perspective to have instant payment or one payment type. And then just get done with it. So it depends a bit on the situation. And I think instant payments are actually wanted and justified in many cases, but in other cases it's also fine to have normal standard payments.
Okay, thank you. What are your views on that, Alison, regarding the instant versus maybe potentially not instant and more secure? And do you think that there's a specific group of customers that would prefer one or the other?
It's certainly something to think about. In the UK at the moment, there isn't, for the vast majority of payments, there isn't a choice for consumers if they're making a domestic payment, unless it's outside of their institution's limits and they want to pay 20, 30 quid for a CHAPS payment, then it will be made by Faster Payments.
Mm-hmm.
There are surveys which indicate that customers would be willing to accept a level of friction, some delay to their payments if it meant that they would be more secure. On the other hand, there's also other surveys which suggest that although customers say that, in reality, when it happens to them, they're still making complaints because they like the idea in principle, but not when it's their payments that are being delayed. So I think there are certainly circumstances where it would be fine. A customer would be happy to use a slower payment method if it was felt to be more secure. There's also, again, it would factor into those fraud typologies that rely on urgency and panic, where sometimes you're just catching a customer at the wrong time. They're pressured, they're in the middle of doing the school run and 42 other things, and it's something that's just hit a nerve with them. Maybe they think they are expecting a package or whatever it is. And almost as soon as they paid it, they think, hold on, now I think about it, something wasn't quite right with that. And you can imagine circumstances where if they think they're making a purchase and they suggest making this payment method, and if there's reluctance or refusal to accept it, it could be a red flag, an indicator that this is, in fact, a scam of some sort. So there's circumstances where it could help. That said, there's some of the higher value, the investment scams, romance scams, they're much longer periods and often involve multiple payments, and the victim is not aware until right at the end that they are, in fact, a victim of fraud. Those I don't see being particularly helped by having a slower payment method. It would also be interesting whether there would be additional fees attached to a slower method,
Mm-hmm.
or what those differences in protections are. If it is more expensive, how many consumers in actual fact would accept a fee per payment of some sort to make a slower payment?
Sorry.
No, I was just going to close with it. It's interesting to hypothesize what effect that could have and whether the benefits might outweigh kind of difficulties and costs of implementation.
But do you feel the customer is currently protected by the current regulation, for example, of reimbursement?
So it's certainly improved consumer protection. When you look at the volumes of APP fraud that is being reimbursed, it's significantly higher than before the scheme came in place. And it's also consistent. It doesn't vary between Bank A versus Bank Z as to whether a customer is more or less likely to get reimbursed. I think it's possibly because of the implementation of those rules, it's really almost hogged the agenda when it comes to fraud for the last 2 years nearly. And people forget that it doesn't include all APP scams. It's only those that are within scope of it. It doesn't include international payments. It doesn't include account takeover fraud or being scammed out of your one-time passcode and things like that. So, and I think the last UK finance report indicated that there could be the start of some displacement from APP fraud to some of those other types that are not included in the protection. So I think going back to something that Dal said earlier, it's a step in the right direction for consumers. I think those in the industry would argue perhaps around the fairness of only financial institutions paying the cost of reimbursement. We may get on to discussing that a bit more broadly as to whether fintechs, whether telcos, the other parties involved where fraud originates ought to perhaps be sharing a cost in that as well. That could be a debate for another day.
Yeah, and Dal, what are your views on that, on the new regulation, on the existing regulation, on the and how what is the bank's responsibility and what is the consumer's responsibility in a case of that FOAPP fraud, for example, too?
Yeah, I think going back to sort of the genesis of the original question, which is I don't think every payment needs to be instant. So I think having that choice is absolutely essential. And every payment is different by virtue of it could be a consumer payment, it could be a B2B payment, which both have different characteristics. I.e., to an instant payment for a consumer, I can see why speed would matter. But there is evidence that we're saying that consumers are willing to accept a little bit of friction to create assurance that the money is going to go into the right hands and not into the hands of a fraudster. Equally, on the B2B, every payment doesn't need to be instant. I.e., organizations have large supply chains. Those supply chains have payments scheduled 30, 60, 90 days. And therefore, making that payment at the instant level would ultimately be, in some respects, a red flag. To Alison's point, you're being coerced into making a payment very, very quickly with a sense of urgency. So I don't think every payment needs to be instant, but consumers and businesses should have a choice. I think in terms of the reimbursement aspects to it, it's progress in the right direction, clearly, to protect consumers and to protect businesses. I do think there's a case for it's not just the banks that are fundamentally responsible for all of this, whilst they may be the custodians for execution of the payment. I think there's broader actors in play. So I think, to Alison's point, there could be a wider debate on who should be paying up the costs in terms of reimbursements. I think that piece around cross-border is highly relevant to our conversation today. So in terms of domestically, even between different jurisdictions domestically, there is different levels of reimbursement. However, the cross-border aspect of reimbursement is non-existing today. So if your money goes cross-border, you got a slim chance of A, coming back, or 2, having any level of reimbursement as it stands today. So more to be done there as an industry at the regulatory level and broader afield.
Yeah, and also, we have seen that confirmation of pay, verification of pay are not bulletproof methods. And even when you get a no match, you can still proceed in sending the payment. And I think they are absolutely put in place up to a point to protect the consumer, but also to protect the bank at the same time from liability. So it goes both ways, and they whatever is implemented is not going to be 100% solving any problems in the industry. You mentioned the cross-border checks, okay, and there are discussions at the moment whether to implement the equivalent of confirmation of pay or verification of pay for cross-border, but it's difficult enough. It was difficult enough to implement it within the EU. Okay, given that the different banks that they had to feed all the client data one way and the other into the central directory. But I think it's going to be even more difficult to implement that globally because you're going to have regulatory data retention and everything. Do you feel that's going to be a challenge, and will ever be possible to have VOP or COP for cross-border payments?
Yeah, I think there is, and this is something that we've designed and brought a product market fit to fruition. So I think in that respect, we've got a single API that connects a number of schemes globally. Now, not every scheme is doing it in the way that COP or VOP is doing. In actual fact, there's actually even distinctions between VOP and COP of how it's done. But the fundamental aspect of knowing who you are paying before you pay is represented in the product. I think the added complexity here is, we've largely been talking about the representation from a regulatory point of view, a bank point of view, a fintech point of view, a compliance point of view. I think in terms of why this is so challenging came loud and clear to me as part of the market discovery we ran across the globe, engaging with participants in fintech, in banking, even at a FIU level. One of the things that came consistently across is for APP fraud, what's really, really challenging and difficult is that the consumer or the business genuinely believes it is a legitimate payment. And this is being driven off the sophisticated scams that fraudsters have developed, i.e. the romance scam aspect is playing on psychological human emotional needs that go above and beyond something that's very binary, black and white in terms of whether you should pay or you shouldn't pay, which makes it extremely, extremely challenging for all market participants, let alone the consumer and the businesses that are really the victims of this terrible crimes that are happening, that frauds are implicating on the market.
And I think it's the same with synthetic identities, as you're saying. The victim believes that they are actually paying the right beneficiary. And Anna, do you think that the banks have enough statistics or enough MI to basically pinpoint those typologies of fraud and potentially find ways to prevent them?
Yeah, I think I can comment to that. Of course, we know that machine learning is used with the fraud detection, right? So the more payments we see, like instant payments or the new payment types we see being executed, then the better the fraud prevention mechanisms become. So there is, of course, gradual enhancements there. And of course, yeah, again, both instant and standard payments, they are still subject to fraud monitoring. So it exists there, right? So, but I completely agree that social engineering is one of the main causes for fraud. And here it's difficult because if the customer is sure that the payment should be made to this specific person, so then probably verification of payee or disclosing the name won't help because the customer is completely set. So I think also raising awareness. So for us as a bank is also important to contact the customers through multiple ways, maybe social media, the newsletters, publish information on our website to raise awareness about potential fraud and scams so they are prepared. We actually see quite a lot of interest. So when we send out the newsletters about the fraud prevention and different fraud mechanisms, we have a lot of clicks. So this is a quite interesting topic for our customers.
Great. And I think the best way that people can be educated is through examples. And I think the banks are now have real life examples that they can do. And I mean, we've seen a lot in the papers as well, the invoice fraud where someone is receiving an email from the CEO saying this is an unpaid invoice, and the fraudster is using urgency and fear to make them make that payment quickly. There is one question in the panel. I think we've pretty much answered the first one, but on the second one, Alison, you would like to answer it. It says, in your experience, how does the fraud profile of cross-border payments differ from domestic payments, and which fraud typologies appear most frequently in cross-border flows?
Yeah, so I think what we see in cross-border fraud isn't so much a difference in typologies, but specific versions of the typologies which will allow those cross-border payments to go undetected. So that can be targeting a victim that makes cross-border payments naturally, particularly businesses, with things like business email compromise, some of the invoice fraud. So, and this is where kind of they're cyber enabled. So they may have compromised emails. They intercept an invoice from a genuine supplier and change the payment details on it. For at a corporate level, a single for a business customer that makes international payments on a daily basis, that's not going to stand out to its banking provider when it comes to transaction monitoring. And so you're looking at victims that typically make overseas payments, and then you're also looking at the scam typologies like the investment fraud and the romance scams, where there's a long period of social engineering of victims. They might initially make a small payment, and when that goes through, or they provide the explanation to their bank, it's then cleared. And so you're reducing the fact that over time they're going to pay more and more because it's building on a previous track record where they've had explanations. If it's been queried by their banks or account providers, then that's again a way of it going undetected. Of course, nowadays, you touched on those kind of CEO fraud there. We've got deepfake videos. It used to be, if you received an email request from your CEO, well, make sure you speak to them or call them. Not so much now, because you might get that through a deepfake video that's of such good quality that their own mother wouldn't be able to tell it wasn't them in the video. And I had another point which has completely disappeared from my head now, but yeah, so in terms of those are the kinds of typologies that work. Oh, that was it. Of course, you don't need to make a cross-border payment if you're getting it to a crypto exchange and converting it into crypto, and that is actually a real vulnerability and probably easier now, especially for smaller, low value, all the typologies that would look odd if that victim, that customer was making a payment offshore for this reason. Get it into a crypto account, and it can be in any country in minutes.
Yeah, I think this is a completely different way of fraud, and I think this cannot be prevented by confirmation of pay or verification of pay. But coming back to what you've mentioned about what Anna mentioned actually about machine learning, and also what you've mentioned about if a corporate is making cross-border payments all the time, is not going to be picked up. But if I've never made the payment from my GBP account into Israeli shekels, for example, should my bank stop that payment and question it before they release it if I've never made that payment before? I don't know who would like to take that. Anna, maybe first, and
Yeah, I think we normally see that payments to new recipients are more risky than what you do regularly, right? So I think there were discussions in general how to have more controls, or like ask customer maybe to do some extra steps when they do a payment to the new recipient. And of course, there are the countries, high-risk countries. There is list where we perceive more risky, others are less risky, right? So there will be some controls that will help to detect. But yeah, of course, can't say completely in detail how that would work. But I think definitely, I think as a general reply, paying to new recipient is always perceived as more risky than transactions that you have done before.
Thank you. And Tal, based on your experience again and what you're working on, the use of AI to detect those types of behavior, should that reassure the consumer that potentially and gives them that extra moment to think, because that payment is not being processed automatically if it is outside of the usual payment behavior?
Yeah, absolutely. I think any risk factors that are brought up front to the consumer or a business, i.e., if you think about verification of pay and confirmation of pay, it's exactly doing that. It's bringing up a risk factor associated to that payment, i.e., who you think you're paying is not who you actually are paying. So any risk factors of that nature, whether it's historical transactions, historical aspects of risk associated to that beneficiary from the receiving bank, all that level of intelligence made up front to the consumer in a very palatable way will allow them to make that decision if they want to make that payment out. And equally, when financial institutions are contacting the consumer or the business, where they have these risk factors up front to inform the customer of, are you sure you want to make these payments in light of 1, 2, 3 risks based on historical transactions, reported suspicious activity, etc. The consumer and the business can make a much more informed decision. And I think AI is being used by the fraudsters. And I think in terms of what the market is looking for in terms of creating trust in the use of AI is things like explainability, to have governance in the use of AI, and not have it just, machine operated, no governance, no explainability. That isn't going to build trust with consumers or businesses. But I think the adversarial response and duty of care that we have to consumers and businesses, AI is a must. And the reason why it is a must is because the fraudsters are using it. So the adversarial response is to leverage it to catch them out more times than we're not doing them that we should be doing, if that makes sense.
No, 100%. And usually we have seen that in every market, the fraudsters are adapting, and they're also going to use the tools that are available to them, that are also available, obviously, to the banks as well. And sometimes they will adapt quicker. And I think that it's to Anna's point, is to educate the consumer via maybe newsletters or communications on how these fraudsters are evolving and what they should be looking out for. But do we think ultimately it's the banks or the PSP's responsibility to always refund the consumer if it's proven that the payment was a result of fraud, or the consumer should bear some responsibility there as well? I don't know, Anna, I'd like to start with you.
Yeah, I think we also generally see a shift, right, of the liability towards the payment service provider. I think the PSD3 talks a lot about it.
Mm-hmm.
And of course, in the cases with the verification of payee, when the service is not available. So I know that, for example, if it's our fault that we are not able to provide the result, so most likely, of course, then we have to reimburse. But it's, it's still a split shared responsibility. I think it depends a lot on the specific situation. But of course, what we can do, right, from the user perspective, user experience, is to inform the customer, right? So then, for example, verification of payee, we can't do it, right? So we need to be upfront. We need to be very clear. There is risk, right? So the customer actually accepts the risk when proceeding with the payment. I think it's important to do that as well.
Agreed. Alison, your views on that?
Yeah, I think it's still an emotive subject in terms of the responsibility for reimbursing fraud and where that sits, particularly because in the UK, the consumer standard of caution is still slightly unclear as to whether it's been consistently applied. And until we've got some examples of good and poor practice on that, or some clarity, questions will remain. I think mandatory reimbursement in the UK, it's a stick approach, carrot and stick. It's a stick approach. It was designed to create a financial incentive for firms to make them invest in their fraud controls, particularly receiving PSPs, who previously all the focus has been around those that bank the victims, but it was to ensure that the receiving PSPs had skin in the game as well. And from talking to our clients, I do think in the vast majority of cases, there was investments put in ahead of the rules going live to really tighten up and in some cases invest in new technology or improve their controls due to the reimbursement. To that extent, you could say that's potentially achieving one of the policy's aims. It's difficult to see whether it's actually had any impact on fraud levels and rates because you don't know what would have happened without it. There's the independent review that the PSR have commissioned into the reimbursement policy that should be reporting, I think it's around the summer this year, and that will be interesting to see what conclusions it draws as to whether the policy has achieved its objectives, which included improving consumer confidence in payments and the payment infrastructure in the UK. But certainly when you look at the data available, quite widely publicised in terms of where frauds and scams are originating, it does seem like potentially not fair, for use of a better word, for the cost burden of that to fall entirely on financial institutions. And there is a limit with the best controls in the world to what a financial institution can do in isolation with the information it has to prevent a fraud. And that's where I think we need to look more at the exploring data sharing and other cross-industry initiatives that are going on, things like Stop Scams in the UK, to look at how firms can work together, need to collaborate to take it up to that next level in the fight against fraud.
Thank you. And Dal, what are your views on that? Should the PSP, regardless of the controls that they have offered to the customer, COP or VOP, for example, still be liable for a full reimbursement?
Yeah, I'd sway away from the consumer taking the brunt. I'd put myself in the shoes of a consumer. We're all consumers here. And if we were left with a gaping hole because we've been a victim to APP fraud, I just don't think it would be something that would be palatable by any of us on this call, let alone consumers out there who are going through that level of suffering. I would side with what Alison shared. I think there's actually more energy, more impetus that we can do as a market. And I'd certainly say, to Alison's point, there's participants in the market that are not playing to the rules because they're not in scope of the rules. And while that's be slightly sort of cryptic, I think we could have a whole session deep diving into who those potential sectors and firms are, not by name, just by sector, who are not fully playing ball. Because as I mentioned, the fight against financial crime, encompassing fraud and AML breaches and terror financing, it's an absolute team sport. And it has to be at a global scale because these criminals, these are not your small-time crooks operating out of a garage. These are industry-wide networks operating at great scale across the globe. And therefore, if we talk about a couple of the areas that Alison mentioned, like data sharing, our ability to share which account, which particular fraudster, we could be sharing that data more broadly across the globe to break these networks down, to break these mass gangs down. That's something that we're not doing. And I think doing that, in addition to increasing participation around these particular regulations, I think is going to create a much more safer environment. So we don't have to, punish the consumer or punish a business that's trying to scale. Exactly. I think we should have a session separately on this on this
No, I agree.
topic. I think
Maybe we need to
there's a
speak
lot
to
of
Bernice
depth to that.
to organize something exactly. And I think there are other aspects as well, that each consumer has a different level of understanding of the financial system, of fraud, of everything really, and we shouldn't be even assuming that the consumer's first language is English. So and so we can know it at different types and levels of consumer understanding, from big corporates to organization to older generation to younger generation. Conscious that we have 5 minutes left. So I don't know, Berenice, if you want me to pass back to you or do some closing comments. Okay, great. Okay. So thank you everyone for participating in this discussion. I think hopefully we've managed to cover a few subjects that the people who have joined this webinar had questions on, and answer their questions as well. I think the subject it's much wider, and as Dal was saying, we can potentially have different subjects or different seminars on different subjects. And Alison touched on crypto as well, which is a completely different subject, and especially with stablecoin coming in, that will potentially open the discussion of fraud and how consumers are going to use it, and also how fraudsters are going to use it. But my closing comment would be that no regulation can be perfect. It comes down to the organization being as proactive as they can before they even have to be regulatory compliant. But at the same time, consumer education is key. And how can the consumer be educated? Obviously, via the financial institution, but also there's a responsibility on each one of us to keep up to date with what's happening. It's very difficult, and I'm going to speak from my own point of view. AI is beyond our capabilities to fully understand it. But at the same time, we also need to try and keep up to date of what is happening. The other thing is that before you make a payment, again, the responsibility is with the individual. Try and think twice. The fraudsters are using certain techniques that they are usually urgency or fear. So if you come across into a situation like that something either sounds too good to be true or too urgent, or they're trying to make you think that your account is being compromised or anything, I think the clear thing here is what we've always been told: don't click on that link.
All right. Well, thank you so much, Vicky, and thank you to all our speakers for your really insightful and interesting conversation. Thanks everyone for today's webinar. If you have any other questions, please contact aisha.raris@thepaymentsassociation.org. There's also a QR code up now for a short feedback form on the webinar. We would appreciate if you could complete it. You'll also be receiving the form via email shortly if you wish to do it later. You will also receive a follow-up email within 24 to 48 hours with a link to view a recording of today's webinar. On behalf of the Payments Association and our speakers, thank you for joining today, and have a great rest of your day.
Thank you, everyone.
Thank you.
Thank you.